Hi there, Serial Trader here. Let's have a look at the major US indices and starting off with the wave chart here on SPX. And alright, well I think I'm just going to delete these subdivisions for our ABC up just because it's cluttering this time frame. And yeah, that looks a little cleaner. Snap everything there where it should be. Alright, so today we had a nice strong session to the downside. Got well below the T line, so good follow through from yesterday's bearish kickoff. And so far, it's responding as you would want it to. If you had a nice, 5 waves down for what I'll tentatively call one at this point. I know I have or A, but currently I'm favoring this going to be a 1, 2, 3 down. But we'll see. I'll leave the alternate up there for now. But yeah, 1 down, 2 up. And so far breaking down nicely in what could be a third wave to the downside. Just beautiful pivot off that 618 Fibonacci retracement. So currently every reason to believe lower lows are in store. And I mentioned the last video there, we have our equality objective down here at 24.77, which in itself is below the February lows. And then beyond that, we have a 1618 objective at 22.69. And, we can even go beyond that if just absolute panic ensues and, you get a real good crash on your hands there. But these are some good levels to be keeping in mind moving forward. We'll have more price data to analyze if we can get down here and get some other relationships to get an idea of some, fib targets and things like that. But right now, those are the two general ones I'm looking at. And yeah, the expectation here is all little bounces up aside. I expect at this point, just analytically here, lower lows to come. So that's probably good for the wave chart for now, as it's only been 1 day since the last video, so nothing substantial to update on other than just, yeah, we've had some nice bearish follow through. Okay, so that being said, we'll go to the Thinkorswim candlestick chart. And alright, SPX daily candlestick chart. So you see we got right into that overbought condition on the daily oscillator. And now we've actually turned down, so coming off the overbought condition. So that's a little bit of confirmation there. And obviously we're coming down nicely as far as actual price action goes. Small gap down, yesterday from Friday's Doji Star, and make that from Thursday's Doji Star. Nice gap down into Friday there where we had some negative trading, and then good confirmation today with substantially more negative trading and closing near the lows of the day as well, which is showing additional weakness. Didn't have the little bounce near the end of the day and stronger close like we did on the Friday there. More conviction to the downside today. Okay, so that's, yeah, closed well below the T-line. Also closed well below the 200-day simple moving average. So that's twice now we've gone below, bounced up, a little bit above the 200-day, and then gone right through it. And okay, and then again here we bounced up, got through the 200-day, basically failed in the same area, our 618 level here, and the previous the previous fourth wave of this impulse wave down, and now coming back down nicely to take out the 200-day moving average once again and close strongly below it. So at this point, we've also closed below the following 20-day simple moving average. So from a moving average standpoint, things are still looking quite prone to further weakness, along with everything else that we're looking at here. All right, that's good for SPX. And we'll go to the Dow Jones Industrial Average. And the Dow, big negative day today. Let's see here. Yeah, it's a big red candlestick. So closing well below the T-line. The Dow may have had one of its bigger moves we've seen in a while here. Certainly the only candlestick I see that kind of exceeds it is this particularly strong one here, and that was on October 10th. But Yeah, this, other than that, this is one of the, I would say, stronger declines from the open to the close there. So the Dow is still currently above its 200-day moving average, although I don't expect that to last too much longer. Oscillator got into the overbought condition and now turning down, so coming off. So that's more of a confirmed signal. You can stay overbought for a while, but once you're overbought and you start coming off that condition, that's more confidence that, okay, you got your peak and you're coming down. And obviously we're nowhere near oversold because we just started coming off overbought. So plenty of weakness is still available for this market here. All right, yeah, that's probably good for the Dow, basically closing roughly on its 20-day simple moving average, but well below the T line. So that's a good early sign of further weakness to come. Okay, that's probably good for the Dow. We're just doing a quick analysis here since my main priority will be going through a trade I put on today. Okay, so NASDAQ composite. NASDAQ's definitely the bearish leader here, just as it was the bullish leader. So not overly surprising. It just has higher beta names in it, so it moves faster in either direction that things are going. So yeah, Thursday, nice doji star on the NASDAQ, right on the 200-day simple moving average. Basically around that 50% retracement, so it had a shallower retracement than the other indices did. Then a nice clear gap down between doji star and then Friday's negative day, which did close just below the T line, and then today obviously good confirmation, very strong down day, down almost 3%, and a close near the lows of the day. Also closing below this little support level we had here, which was at 72.55. So closing well below that, and really we're coming down here almost. Today we didn't quite do it, but looking to close the gap here, and to close it, we'd have to get to this candlestick's high here, which was at 73.68. Sorry, 71.66. I stand corrected there. And I don't think we'll just close the gap personally. I'm kind of leaning that we close it and then maybe some sort of bounce or reaction off of there, potentially. Doesn't have to. And then we start gunning for these October 29th lows and likely well below that once we break it. So yeah, outlook for NASDAQ looking quite bearish, and obviously the overall market is sharing that sentiment. But this is the lead bear for sure. Okay, that's good for now on the NASDAQ. And, well, I guess one more remark, I suppose. The 3T line now clearly crossing below the T line, so you have a nice little bear cross there as well on those moving averages. Okay, that's good for the NASDAQ. Go to the VIX. And VIX, okay. Oh, VIX had a nice strong day. Closed near the high of its range, went as high as 2071 and closed at 2045. So VIX is coming back to life, and interesting how we had that nice reaction just off that 200-day moving average for VIX. We also have that 50-day crossing above the 200, so a golden cross on VIX for however much worth that is. But bottom line is, if VIX is resuming its uptrend, that definitely complements the resumption of the downtrend on the equities there. Okay, and if we really get exploding and start taking out the previous VIX high, which was 2884, you can pretty much rest assured that at that point we've already taken out the October 29th lows and probably challenging the February lows on the indexes. Okay, so that's fine for VIX there. Now, what was I actually going to get to here? So today I opened another position with SPY. Still have the 290 puts from before, but it's not an enormous position size. And I was thinking here, how do I like that we got, the SPY is the same as SPX. It's basically the mirror image as far as the actual chart goes. But it's just the ETF, right? So we got our 5 waves down for 1. Looks like we have our 3 waves up for 2, just like SPX. and now coming down in potential third wave. So what I was looking at is, okay, I have some targets on SPY. The equality relationship is at 247, and then the 1.618 relationship is at 226. So those are just the equivalents of those levels I showed on the actual SPX chart before. So my mental thought process here was, okay, I'm fairly high in conviction that we're going to come down and take out this low. And if we do take out this low, I'm quite confident that there will be a significant leg down. I don't think we'll just touch the low and make a marginally lower low. That seems unlikely. There's probably a ton of stop losses, just a mountain of them waiting just below these lows. And if we take out the lows, you're just going to see forced automatic selling, and then that'll just lead to even more selling, margin calls for people that tried to lever up on this rally, and you name it. It's likely going to cause a nice panic, decline there. But my whole thing is, okay, if that happens, the best thing to do is just load up on a bunch of long puts here and ride this thing down into the ground and kill it. But I have to entertain that. What if the low doesn't get taken out? What if we come down, fill the gap, test the low, but it holds, and then we resume some sort of uptrend? However unlikely that may seem at this point, it's still possible. Maybe not probable, but certainly possible. So what kind of position can I put on? Because I want to have a large position here. In case this actually goes, I want to have a large position so I can make a lot of profit. But I don't want to get hurt if I'm wrong, and if you have a large position of just long puts, and this thing, starts going up again, well, you can start losing pretty quickly in that sense. So I thought I have a good strategy for this kind of scenario, where you're confident that there will be a large move if a specific level is to give way, and that's what I think the current situation is here. So that being said, I did let's look at the order fill there, filled order. I did Thinkorswim calls it a back ratio spread, and you can call it a back spread or a ratio back spread, or like it says here, back ratio spread. But what it is you purchase a larger number of out of the money puts and sell a smaller number of still, in this case, still out of the money puts, but closer to the money. So I bought 180, the quantity 180 of these January 2019 puts, 247 strike are the long contracts, and I sold 90 of the 260 strike puts, same expiration date, January of 2019, and then those together for a very, very small net debit. Okay, and I'll get to what that means in a moment here, but let's go to the risk profile chart here. So this is my position, illustrated currently as it stands. And okay, so you can see anything. Let's see, anything at 260. So anything at or above the strike of the puts that were sold at expiration, mind you, which is the teal line, represents at expiration. So on the 18th of January 2019, anything there or above, you only lose the relatively modest debit that was spent on the position, which is $1,440 was the actual debit. Okay, and then I'm going to work with this purple line first. So the purple line shows that, okay, right now if we just start going up, we basically just are flat. Nothing happens. So if this completely rallies in the face of all my bearish expectations and doesn't break down, this is going to be a relatively harmless situation to be in, and just hold this thing or just close it or whatever, right? Now, this purple line shows that we basically immediately start gaining more and more profit if we start going down, and obviously it's going to accelerate as we get closer and closer to the actual strike price of the long puts, which is 247. Okay, and well, I'll just go to the SPY chart for a moment. So what if we get to 247, right now as it stands, that would currently bring us to $26,000 profit on the purple line. So purple line is what matters now. Teal line is what would matter on January 18th, 2019. Now, what if we go down to our 1.618 objective, and that would be 226, okay? So if we go down to 226 as it currently stands, that'd be 108,000 roughly. So 110,000 right around that 226 level, okay? And even at expiration, that would still be 70,000. So your actual break even to the downside at expiration is 233, but currently, since we're well before expiration, this thing starts, gaining profit smoothly and basically all the way down. And obviously, the further down we go, the more it accelerates too. So how does this work? Well, the thing is, we have twice as many long puts as we have short puts, but they're at a lower strike price. So yes, the delta, okay. Well, let me just look at this for a moment. The delta of the 260 puts is, since there's 90 of them, I'll give the overall delta. The delta of that is $2,453 per $1 move in SPY, right? But the delta of the 247 strike puts, since there's 180 of them, yes, it's overall the actual delta is lower on the 247 strike because it's 13 strikes below 260. But since there's twice as many of them, the actual overall delta is greater. It's negative 2,688 currently. So the overall position delta is actually negative 235 right now, and obviously that would start changing quite a bit once we got to lower levels. But currently, it doesn't have a very high delta, so it's not going to respond very quickly until we start breaking down. And it is long Vega, so the thing is, if you decrease in price on SPY, you're going to see volatility pick up, and the implied volatility increase will actually be a benefit since we have positive Vega, okay? And the reason we have positive Vega, yes, we've sold 90 contracts, but again, that gives us a negative Vega, so an increase in volatility would hurt those contracts, but that gives us a negative Vega of 35.20. Whereas, again, we have twice as many of these 247s, so even though their overall Vega is less significant, since there's twice as many of them, it's more. So that gives us a positive Vega, which would benefit for every 1% increase in implied volatility. That would benefit them $4,937, okay? And that means that overall, as a position, we have a positive Vega of $1,416. So an increase in implied volatility, which would coincide with bearish action, that's a benefit of this position. And obviously the delta and the gamma are going to be factors as we go lower and accelerate, right? And the theta is quite minor. It's almost non-existent as it stands here. But so really, it's not a risky position as long as we're not close to expiration. Now, if you're getting closer to expiration, now you see this zone, this potential loss zone, right? And obviously the maximum loss is basically right at the 247 strike at expiration, okay? Because the 247s at expiration are worth nothing unless they're below 247, and at expiration the 290s are going to be worth $13 each, and the 247s, sorry, the 260s will be worth $13 each, and the 247s will be worth 0. So that's your maximum loss, and that would be 116,000 or so, something like that. But again, that's at expiration. This is not what we're intending to do with this position at all. So I bought January's because I think this is something that could happen in the next couple weeks to a month. And after that, if what I wanted to happen doesn't look like it's happening, I'd probably just close the thing before before this purple line could start creeping down towards this teal line. And let me just illustrate that. Because right now, we're basically in a nearly riskless position. If we start going down nicely, we gain nicely all the way down. If we just go up, we're flat. There's really nothing happening. But if I advance time, one day at a time here, you can see every day that goes by, the purple line starts going down, getting a little closer, but it doesn't go down quickly until we get a little closer to expiration, okay? And then we start accelerating, and you see here, you know, now we're into late December. It really started, let's see here, it really started moving here mid to late December, and now we're getting into January, and you can see we're getting closer and closer to the teal line. So now the risk, if we're in the range between, well, technically the range is between 233 and 260, but the real risky range is kind of, let's call it, you know, 240 to 255 or something. So anywhere in there is a place you don't want to be, you know, anywhere near expiration. But again, this is where the position will be managed, right? So let me just get back to today's date, which is November 12th currently. So yeah, this is just going to be a situation where we either get what we want, we get our third wave down, and you know, we get down into this nice profit zone relatively quickly, you know, within a few weeks. Maybe we hit our, you know, 1618 multiple, get down to our 226, put some pressure on that. And if that happens, great. You know, massive profit there. Or we come down, test our lows, they hold, and start coming back up. And if that happens, and that 260 area on SPY holds, and we start coming back up, I'll just close this thing and move on to something else. So really no harm, or very little harm, will be done there. What I'm not going to do is let it stick around in this range and get anywhere near expiration. So price really isn't the enemy of this kind of position, of a ratio spread here, or a back spread. Price is not the enemy. The only thing that is the enemy is the, you know, progress of time. But even time isn't the enemy until you get closer to expiration. So this is the kind of position where you want to be very, you know, good about managing it and buying way more time than you think it'll need, so that by taking the time you think you'll need, you'll still really not be letting the thing decay a whole lot. So now in this case, I did a 2-to-1 ratio between long puts to short puts, but you could go a higher ratio. But by doing a higher ratio, you'll just simply have a higher debit, and then you know, a higher loss that you could observe if you're trading above the strike price you sold, right? In this case, I wanted that to be extremely small in case it actually resumes an uptrend, and then it's basically just a scratch trade, right? But by having a higher ratio, you also have more profit potential if you're right. So say we did a 3-to-1 ratio, right? And I, you know, was long 270 of these 247 puts, and still just short 290 of the 260 strike puts. It would make a lot more money if we get the result we're looking for, but it could also lose quite a bit more if we go up, because that initial debit would be significantly higher than, you know, the 1,440 that it was in this case. So I'll definitely follow up on this one as I do whatever I do with it, close it, or take follow-up action when the time comes. But I thought I'd present that because it's a nice strategy for basically having an idea and having a pretty strong level of confidence that if you're right and you break down this key level here, you're really going to break down quickly. And that if you're wrong, you just don't want to have any damage done to you. And this is kind of a unique position that allows you to do that. And as long as you pick enough time and don't let it get anywhere near the expiration date, the risk, you know, it's small. There's just nothing risky about it as long as you do it correctly. And I think I've laid that out here with pretty good explanation. But certainly if you have any comments or feedback or questions about that, I'm more than happy to answer it. anyways, that's probably good for now. And let's see if we can get some extreme, downside action here in short order. Obviously, I'm certainly looking for that. All right, check in later in the week sometime. Serial Trader signing off.